All right, guys, this is going to be your post-market wrap-up for the New York session for Thursday, October 13th, 2022. And we're currently sitting at 1:42 p.m. Pacific Standard Time. Markets have been closed for a little over 42 minutes now. We did see quite a reaction today, obviously, in the New York stocks. S&P is driving the force, as I mentioned before. So from our low of today to the highest high we made, it was actually a jump of 5.52%, which is pretty spectacular. I had mentioned earlier that we're going to see retail pile into this. So retail drove this. We hit the demand zone. We saw the European Central Bank make a statement right as we hit the demand zone, ironically. And of course, retail money started to flow in. How do I know it was retail? You can check through volume and whether it's spot derivatives, amount of purchase. So obviously we're seeing not huge buys. Smart money again has left the market. So what we're seeing is small purchases. Of course, we still have some hedge funds, other entities of that nature involved in the market, of course, but nothing like massive purchases that we're used to historically in the market. So retail did get caught up in this. They drove this up a bit, but something caught my eye, and I thought, this is interesting. First, we were able to take out the resistance that we had lost as support. That's going to be your 3636.87 support and resistance. We were able to reclaim above that. And as soon as that happened, I started wondering, okay, this is interesting. What else is going on in the market here? I went ahead and waited out the rest of the session just to see what we were seeing. So again, key indicators that I mentioned last night, key indicators in market environments like this are going to be your debt market. And of course, what the US dollar is doing. So let's go ahead and talk about that real quick, and perhaps we can understand why we saw the reaction that we did today. All right, so right off the bat, the first thing that caught my eye is going to be the 10-year yields, 10-year bond yields. Those suckers came down pretty decently today. We were above 4%. We were able to peak above that. It was yesterday, I believe, that we poked our head. We dipped back down a little bit, and we got back up there, of course, today with that CPI print, of course, which drove that to go up. Debt market's going to go up as people get all scared about the inflation being higher, and holy crap, they told us it was going to drop, and it is not going down. So that caused that to jerk up. Now, it pulled back, and it pulled back to a pretty heavy level of volume. Now we have to go, okay, why is the volume so large? And it's spot volume. It's not derivative driven. That's a interesting way. Derivative driven. This is spot buying. I started wondering, I said, okay, could this possibly be the Fed purchasing bonds? Are they buying debt? I'm not talking about the reverse repo, which we discussed yesterday. That only happens at night, and it's only out there for select corporations, big banks, pension funds, etc. This right here, this is an open buying without announcement from the Fed. They're buying assets, and they also bought some stocks here. So it's, a lot of people call this plunge protection team. So the Fed is the plunge protection, preventing things from just straight rock dropping down. And it looks like the Fed intervened a bit here. But are they going to come out and say that? No. Okay, if they came out and started talking like that, it fucks up everything that they've been telling everybody for the course of these last 20 months or so, right? Again, November to where we are currently. So almost, we'll go further than that because obviously we've been raising rates. But I think the Fed's stepping in a little bit here. Are they going to be here to save the day? No. This is very temporary. We still have a whole nother trading day tomorrow. I think this is going to be that dead cat bounce that I told you guys about. So we're seeing it happen right now. Can this market push higher? It can. And I discussed that earlier today, and I gave you guys some levels to look out for. So if you didn't catch that, I'll just go ahead and give you the next two levels that we're watching to possibly have a turnaround back to the downside. Okay, so on the 4-hour of the S&P 500, the ticker symbol is going to be SPX. That key level of support, again, was the 3636.87. We managed to get back above that. We're currently holding above that. I'm going to have to check the futures market. Let's actually look at that right now and just see how futures are trading. Yeah, so it's about the same anyways from what the market closed at. Okay, so the 50 EMA, we discussed this earlier today. The 50 exponential moving average on the 4-hour chart always represents some strong hammer time, meaning it's resistance. Every time the price jumps back up to touching it, it gets hammered back down. Okay, so we're not at that level yet. So that's a level I would be looking out for to see if we tap into that. If you're looking at this on your chart, if you do technical analysis or you're monitoring just the charts, you would see that we've touched that 50 EMA a couple times. Just in the last, really, you could look at this going back to the beginning of September. You'll notice that every time we tap that 50 EMA, we get suppressed back down. So that's what I'm expecting we might see here. We are making a higher low on the relative strength index, which does tell us that we probably have some room to push up to test that 50 EMA and see if we get suppressed. Okay, so let's say that the Fed continues its buying operation that we're seeing, that we saw today begin. And it's not large amounts. It's not like what we saw the Bank of England begin doing, right, to save the pension market. They're not buying anywhere near those levels, but they are purchasing. It is the plunge protection team. So the next resistance, if we do get above that 50 EMA on the 4 hour of the SPX, which is what? It's going to be the S&P 500. If we get above that, the next Fibonacci resistance level, which I would be surprised if we can flip that into support, it's going to be 3906.21. And when you draw that out and you look and you zoom out of your chart, you'll realize how important that level has been historically, just in recent going back to, you could look at it this whole year and see how important that Fibonacci level is. So those are the two regions that we're watching closely. I'm protected. I'm not worried. I've been short in this market for quite some time now, so my entries are pretty high up there from where we are currently. I think one of my larger bids, I actually got in at about 4,300 on the S&P. So I'm okay. I'm protected here. I'm not sweating this little dead cat bounce. And I was in anticipation, as I told you guys, we're going to see a little bit of a relief wave here from that demand zone. So we'll keep an eye on this. Again, crypto is following what the S&P is doing. It's following what the dollar is doing, which leads me into, we just discussed the 10-year bond yields and how those got pulled down. And I mentioned that we are seeing the Fed do some money magic here. So let's talk about the dollar in comparison to what we're seeing. The dollar had a strong pullback today. So as we discussed, when the dollar is surging up, everything that's priced to the dollar, which is basically everything, because the dollar is the global reserve currency, when that thing goes up, all other assets are going to reflect negatively. They're going to go down. Now when the dollar ends up going down, you're going to see those other assets begin to go up. Okay, so the dollar came down today, so you guys can see my representation here. Of course, dollar's down, debt market's down, therefore everything else is going to rise. So we did lose a interesting level here. It's going to be the 50 EMA, which we've talked about on other charts. We did lose that on the 4 hour of the dollar. It doesn't mean that we're in the safe zone. Absolutely not. Where we rejected, actually, and I'll post the chart after I post this update so you guys can visualize what I'm seeing on the dollar here. It'll probably make a lot more sense. So re-listen to this audio as you're looking at that chart. It'll definitely help you. You'll notice that we rejected in my pink box. That pink box is a resistance region, meaning that the price will likely go up into there, but it's going to have a hard time trying to get above it. Now, if we do get above it and we hold it, then we can anticipate that the next region above that, the next supply zone, which is also in pink, would be where we would target more resistance. Now below it, because we rejected from that region, that zone. Now we're looking for a reaction in what's called the demand zone, where there's demand to get the dollar back up. We're not quite there yet. So we might see the dollar go ahead and drop into that demand zone and bounce, and we'll take it from there. We might even range. It's called ranging, where you're kind of bouncing from a demand zone. You go up and you hit the supply zone, you reject, you fall back down to the demand zone, and you're just kind of ping-ponging back and forth. That's called ranging. You're ranging within an environment, or you have outlined a range where that price action is evolving around, accumulating. So I'll go ahead and post that, but that's what's going on in the markets. Basically, everything is following the S&P. So as I said, it went up today. We did see a growth from daily low to daily high of 5.52%, which is pretty decent in this economic environment. But that's what we're monitoring, guys. Hopefully everybody made some profits off of this today. we're able to, or you're just monitoring it and you're starting to get the hang of what's going on here. But I'll go ahead and post that chart. All right, guys, that was going to be your daily market wrap up for the New York session. And it is now 1:52 p.m. Pacific Standard Time. I'll hop back in here in a bit and we'll see what rolls through. Talk soon.